So good afternoon, everyone, and thank you for joining this webinar series, one of these webinar series organized by the Issam Fares Institute for Public Policy and International Affairs. Today, we are glad at the Energy Policy and Security Program to host this interesting and exciting webinar with among three panelists to speak about the oil market outlook and the OPEC Plus dynamics amid the COVID-19. So it's been a very tough year when it comes to the oil markets, and everything was unexpected in terms of demand growth and supply as well. So before kicking off with my introductory and then move to our panelists, we'd like to mention this webinar broadcasted live on the Fares Institute Facebook page. So please feel free at any point if you have any questions to put on your questions in the comment box on Facebook or either here in the Q&A via Zoom, and I will try with the time left at the end of this webinar to address as many questions as possible. I'm very glad to welcome today with us on this webinar Dr. Carol Nakhle, who is the founder and CEO of Crystal Energy, which was awarded the best independent energy consultancy in the UK in 2018. Dr. Nakhle is a very recognized international authority when it comes to global energy issues, in particular at the interface and in the fields of oil and gas markets, energy policy, governance, regulations, and fiscal regimes. So she has worked a lot with oil and gas companies around the world at the executive level, with governments and policymakers, as well as with international organizations. She is also a lecturer at the Oxford University and also at the University of Surrey, and commentator on energy and geopolitics in the press. So Dr. Nakhle, welcome to the IFI webinar. We're very glad to have you among us today. Also, we have, and I would like to thank Herman as well for his time. I know it's a very busy time now. The OPEC Plus meeting is about to kick off in a few minutes. And we're having Herman with us for the beginning of this webinar, and then he might be leaving us to cover the OPEC meeting. So Herman, welcome and thank you again for your time. Herman is a London-based managing editor of S&P Global Platts. He's reporting on OPEC and overseeing coverage in the Middle East energy news. He is in principal editor for Platts and followed closely all the OPEC news and production surveys, and also managed a team of reporters based in Dubai and correspondents in the Middle East. Prior to this, Herman was a senior editor for Platts based in Washington and covering the US energy policy. So we'll be also glad to get some non-Middle Eastern as well perspective when it comes to the oil markets and after this tough year. And last but not least, I'm happy to welcome Youssef Shamari, a dear friend, who is the CEO and head of oil research at Sea Markets. So Sea Markets is based in London, UK, and he is a former research fellow in energy economics at the OPEC and the University of Vienna. So we'll be benefiting from his presence today to listen to his insights when it comes to OPEC Plus dynamics and what has been happening during 2020 and for the coming years. Youssef is a well-known analyst and a media commentator on energy and oil markets at the OPEC ministerial meetings, and also he is a writer at several websites and energy magazines, and his articles have been featured in multiple business websites. So welcome everyone. I'm to allow Herman to give his insights when it comes to the OPEC meeting happening now. I will start with Herman, but before that, and quickly, to give some a brief on what has been happening this year and why we decided at the Islam Affairs Institute to hold this webinar today. So this current crisis and the pandemic we have been living in 2020 is a bit similar to the crisis the world has been living in 2008 financial crisis, and also the 2015-2016 price crash when it comes to the oil markets. But if we want to compare after the aftermath of 2015-2016, this price collapse led to the realignment of all the geopolitics of energy when it comes to energy specifically. And we have seen the OPEC Plus and this alliance between the Russian and Saudi partnership that came from 2016, and then until March 2020, everything moving slowly until the pandemic, the COVID-19 pandemic occurs. So today we are living in a drop in demand for oil products, around 6% when it comes compared to the first month of 2020. We have a delay in recovery. We have a tough recovery when it comes to the markets, especially with the resurgence of the COVID-19 numbers at several areas in the world, in Europe, in the United States, etc. On the other hand, this week, the ministers of the OPEC Plus or the OPEC were holding a meeting, and today we have the OPEC Plus meeting. Now Herman will be telling us more about it, to decide on the future of oil markets, whether to defer easing on production starting January 2021. And the image, if you want, or the vibes are a bit uncertain. There is still no consensus among countries, specifically the UAE and Russia and Saudi Arabia, when it comes to the future. And this is why what Herman and Dr. Nakhli and Yusuf will be telling us is very important, and gonna draw the path of where we are heading in terms of OPEC and OPEC Plus, and also oil markets and those dynamics during the coming year and the years to follow. With this perspective and with this scene, I would like to give the floor to Herman to start with his intervention. Herman, I know you've been following closely this week on everything happening in the OPEC meeting in Vienna starting November 13, Monday, and the meetings were postponed from December 1st until today, and it's going to start in a few minutes. So if you can give us a bit of an internal or insider view of what's happening, where are we heading, why is this delay happening, and what do you expect in terms of outcomes of this meeting?
Well, sure, Mark. Well, thank you so much for inviting me to speak on this webinar. And it is an exciting, I don't know, exciting is the right word for it, but we've got the OPEC meeting set to start any minute now, as Mark mentioned. And so I may have to jump off the minute it starts. We're kind of in a holding pattern right now. But while I'm here, I'm happy to talk about OPEC. Just maybe save all your tough questions for Dr. Carroll and Dr. Yusuf for after I leave. So I have some slides to share. Let me see if I can do this without crashing the whole thing. Let's see if I can do this. All right, you seeing that?
Yes, seeing it clearly.
If I can do this in a
presenter view, if you like.
Presenter view, yes. Oops. Sorry. There we go. Okay. All right, are you seeing the slides now?
Yes, very clear.
All right, so I thought I'd just start with an introduction into OPEC and why do we care about OPEC? And, you know, I don't know how familiar those of you tuning into this webinar are about who OPEC are and what do they do and why are they important, or if they're not important. You know, I tend to think that they're important. I cover OPEC, so I've got to think they're important. But they are a coalition of oil producers, oil exporting countries, and there are currently 13 members right now. So this map on the left there it's last year's map, so it's a little out of date because Ecuador has since left. This has been traditionally dominated by the Middle East, as you might imagine, but there's a growing African contingent within OPEC over the last couple of years, a growing membership in Africa has kind of shifted a little bit of the dynamics within OPEC and as they try to establish oil production policy, and that's what they do. They're a body that decides how much oil to produce in the months ahead. And they do this as an attempt to try and balance the market according to what they say. They do. When we talk about balancing the market, that is an equilibrium between supply and demand. And when supply exceeds demand, oil prices tend to go down, and that's not really good if you're a producing country that depends on oil revenues for your economy. And when demand outstrips supply, prices go up, which you might think is a good thing for OPEC, and it is to an extent, but if it gets too high, then the world might tip into recession, and that's a bad thing for everybody involved. And so they try to fine-tune this balance between supply and demand, and sometimes they're successful, sometimes they're a little too late to the party. But so that's actually the point that we are in right now, where the pandemic has really decimated demand, as Mark mentioned. Demand at its worst was about 20, maybe even 25 million barrels per day below pandemic levels back in the spring and during the worst of the pandemic. And that's created a lot of havoc in the global economy and havoc for these producing countries. And so they've instituted deep production cuts. And it's not just OPEC. We talk about OPEC Plus now. This is a new moniker that's been created. OPEC has teamed up with Russia and 8-9 other countries to form this coalition called OPEC Plus. Russia is the main member of this enlarged group. Saudi Arabia and Russia are the two of the three largest oil producers in the world, the other one being the US. And they kind of trade that top spot between the three of them, depending on market conditions and what's going on with OPEC cuts. So adding Russia to the mix has really boosted the market share of this group. And so a lot of obituaries have been written about OPEC, that OPEC is declining, OPEC is less relevant in a market where the US, for example, which is outside the group, is increasing its production, becoming a net exporter. And so OPEC's market share has declined from over 40% of the market down to about 1/3 of the market. But then you add in Russia and these 8 other countries, and all of a sudden OPEC Plus, their market share goes up to about 50%. And so when the question is asked, does OPEC matter? Does OPEC Plus matter? Yes, it does matter. And we see the oil market respond to their moves and respond to what they're doing. So they are very much relevant, although there are a lot of questions about how relevant it can continue to be in a world where perhaps there is peak demand right across the board, right across the corner. And maybe Dr. Nakhleh and Dr. Shomari may comment on that in the future of OPEC in their presentations. So as you can see from the share of world crude oil reserves, it's quite substantial. So still a force to be reckoned with, even if it is slightly diminished from what it used to be in decades ago. So what does OPEC do? Well, they meet twice a year typically, more so when there's a lot of volatility in the market, but typically they only meet once in the spring and once in the winter. And so right now we're kind of in that winter meeting where they decide on what to do in the months ahead. And OPEC, prior to the pandemic, they would meet in Vienna, in the Secretariat in Vienna. And Dr. Shomari, you used to work in the Secretariat, so you can maybe provide a little color for what it's like to work in the organization. But these were what meetings used to look like. You'd have crowds of reporters and analysts descending on these meetings to try and figure out what their plans are. Oil is the world's most traded commodity, so it has a huge impact on the global economy. And these reporters, myself included, are trying to figure out what exactly OPEC's intentions are. And you can see that no social distancing happening here. It's all, you get cozy with 300 of your closest reporter friends and rivals, and all trying to break news as quickly as you can and get it to the market and see how prices react. And now we're in a world in 2020 where diplomacy is having to be done on Zoom and on WebEx and Teams and all these internet online programs that prevent or that allow consultations without face-to-face. And some of that is perhaps impacting some of these talks. We all know from having been in this pandemic that there are pluses and minuses to webinars, as what we're doing right here, and certainly there's a lot of convenience in being able to schedule webinars and not having to fly everybody into Vienna to do this. But at the same time, face-to-face interactions are so valuable when it comes to diplomacy and when it comes to hammering out difficult negotiations. And maybe that's part of the dynamic we're seeing here with this deal taking so long to hammer out. As Mark mentioned, OPEC met on Monday. They were supposed to meet with Russia and the non-OPEC guys on Tuesday. OPEC, the meeting kind of fell apart. They reached an impasse on what to do. And so they delayed the Tuesday meeting up until today. It's supposed to start an hour and a half ago. It's still delayed, so we're still kind of in a holding pattern. So, you know, maybe if they were able to meet in person, they could hash out some of these difficulties and you know, or maybe not. And it's also created a different environment in terms of reporting on OPEC. And, you know, from the previous pictures I showed, you know, you're able to be there in Vienna, you're able to have meetings with delegates, meeting with analysts, and kind of get a better picture of what's going on inside the room. And, you know, as a reporter, you're only as good as your sources, and source development, really the key to that is face-to-face time with these sources. Instead, what we're getting a lot of is now communication via WhatsApp. And, you know, you get, you know, and then these ministers are also talking to each other via WhatsApp. So it's just a different environment. And, you know, in Vienna, you can have coffee with a source and kind of get the inside scoop from them. Now, instead, you get WhatsApps and text messages at all hours of the night. And, you know, maybe your wife asks, who's texting you at this hour? And you say, don't worry about it. It's just a guy in Abu Dhabi. Yeah, so that's just a different world that we live in today for how OPEC diplomacy happens and how OPEC reporting is happening. So, you know, I'm sitting here in my room here waiting for the meeting to happen and waiting for WhatsApps from my team and WhatsApps from my sources to tell me, you know, this is what's going on. So what is this deal that we're talking about? What are they negotiating? So we're here in as we see here in December. This is the deal that they came up with back in April when oil prices were crashing. They came up with this deal to cut 9.8 million barrels per day from November 2018 levels. And this is the largest coordinated production cut in history. And so this is 10% of the pre-pandemic market. So the pre-pandemic market was about 100 million barrels per day, and they cut about 10% of that. The cuts eased in August as the global economy looked to be recovering. And then they were scheduled again in January to ease even further, down to 5.8 million barrels per day. And this is all on the assumption that the world will be recovering from COVID by now. But as we all know, we're seeing second waves, third waves of infections. And even though there's been positive news of a vaccine, that's still probably several months away before it's deployed on a global scale. So there's a lot of uncertainty in the market about the world today. You know, here I'm sitting in London, where there's a nationwide lockdown in England just lifted yesterday, but we're still under very tight restrictions in terms of how many people can gather and who can travel to what. And so this is all having a huge impact on fuel demand and jet fuel especially, and even you know, road fuels. So the OPEC wants to kind of be cautious in terms of what they do and not releasing too much supply going forward. So, you know, this is what OPEC is trying to decide today, and whether they should allow these production cuts to ease as scheduled or not. And so, and part of the problem that sticking up the negotiations right now is this idea of compensation cuts. And countries that violated their quotas over May and through December are obligated to make up for their overproduction with these compensations in the coming months. But as you can see from this table, not all countries are playing ball. Not all countries have submitted their plans to implement these compensation cuts. And so this has upset some countries like the UAE, which is, yeah, they've violated their quota back in August, but they've made up for it. They've actually more than made up for it. And they're a little upset at the other members for basically blowing off their commitments. And so this is what's a big sticking point right now in the negotiations that they're trying to hammer out. So this is just another way of illustrating that overall compliance with the cuts is pretty strong. It's 100% October, according to our latest data at Platts. But compliance among individual countries is quite patchy. So you can see Gabon is even in negative compliance, which means they've raised production instead of cutting. So which is contrary to the spirit of the agreement. And just a couple notes here. Iran, Libya, Venezuela are exempt from the cuts because Iran and Venezuela are under severe US sanctions and their oil industries has been decimated. Libya is exempt because it's been embroiled in the civil war. but there's been a ceasefire and its production has come back strongly online last month. And so that's another factor that OPEC Plus is having to deal with. This was a comment by the energy minister back in September at a monitoring committee meeting. And he was basically warning people not to doubt OPEC and OPEC Plus. We will never leave this market unattended. Whoever gambles on this market will be ouching like hell. So basically, don't question OPEC Plus's resolve. And you may be doubting whether OPEC can hold it all together within these meeting delays and all this disputes that they've been having. But my sources are telling me that they're somewhat close to a deal. They're just trying to dot the final I's and cross the final T's on this and come up with a deal that will be satisfying to all, which is difficult when you've got almost 24 countries with competing budgets and competing priorities. The UAE, this is a big bone of contention right now. The UAE is one of the biggest obstacles to a deal right now. And why is the UAE opposing this? Well, they've got huge ambitious plans to increase their oil production, and they've got a big spending plan on their upstream to develop more oil. They've got a production target of 5 million barrels per day. They're currently producing like 2.7 million barrels per day. So almost double of what they're doing right now. And they are launching a new crude futures contract. It's a little bit in the weeds, but they want this new crude futures contract to be supported by their production of Murban crude, which is a key grade that they produce. And this could kind of reconfigure the way that Middle East crude oils are traded on the market. And so these are the kind of the back reasons for why the UAE is resisting deals to continue cutting production. The other factor in this is that different countries have different points of economic pain. I point you to that second column in this graphic that we actually just produced yesterday, the fiscal break-even oil price. What does that mean? This is the price that their budgets are set on for spending to equal their revenues. It doesn't mean that this is the price target that they're aiming at. It just shows that if all things are held equal, all taxes are held equal, they don't raise any more debt, this is the price level that oil would have to be at for their spending to match their revenues. And you can see that it varies quite a bit. Russia is more insulated from low oil price pain, although oil prices right now are below that $57 per barrel fiscal break-even price. Saudi Arabia is higher, and then higher yet is Iran and Nigeria and Venezuela. And so these are the competing factors within the group. And I talked about Saudi Arabia and Russia. These are the two co-leaders of OPEC Plus. They, as much as they're cooperating in OPEC Plus, they are also competitors on the market. And a lot of, this doesn't get mentioned a lot, but there is a lot of intra-OPEC Plus competition for crude customers. And so these are the different streams of crude that they produce and the customers. And you can see there's a lot of overlap. And so, Saudi Arabia and Russia, they talk about being allies and friends, but they're more like frenemies. They're the competitors. So, that's a dynamic that we've all been watching. The latest news in this is that Russia wants to gradually increase production. Saudi Arabia wants to keep production capped. And so that's another issue that they're working out. Wild cards in the market. Libya, I mentioned on the left. Libya has a ceasefire between rival groups, and that's caused oil production to rise by about 1 million barrels per day out of almost nothing in about a month and a half's time. And so Libya is exempt from a quota, so they don't have they're not subject to these cuts. And so that's a potential concern for OPEC as they try to balance supply and demand. On the right is Iran. Iran is under sanctions, as I mentioned. There's a lot of speculation of what President Biden may do with Iran, and certainly much less hawkish on Iran than Donald Trump is. Biden was, of course, vice president under President Obama, who negotiated the nuclear deal with Iran and allowed Iran sanctions relief that brought about 2 million barrels per day of Iranian crude back online from sanctions. Our Platts Analytics arm estimates that within a year of lifting sanctions, if Biden does decide to lift sanctions, and that's not a certain thing, 1.5 million barrels per day could return within the year. So that's something to look out for later in the year. I'll end it there and allow my friends on the panel, Carol and Yusuf, to make their remarks, and happy to take any questions as long as I'm here.
Thank you so much. Thank you so much, Herman. So we're still hoping that the meeting might be delayed a bit more to have you among us, like, because I'm receiving a lot of questions now when it comes also to those dynamics and the next moves, and what about for example, we are hearing about the death of OPEC, for example, and now you are seeing something way different or to the other side. So with this great kickoff intervention and presentation by Herman, I'm happy to move to Dr. Nakhleh. Dr. Nakhleh, you have been covering or speaking a lot also about the different forecasts throughout the year, before the pandemic, during the pandemic, and today, while we are in the middle of the pandemic, but we have like a vaccine coming out in the first quarter, hopefully on that. So we are eager to listen to your insights on what is the impact, what has been the impact of COVID-19 on the oil market specifically, and what are your comments on the current OPEC dynamics and the lessons learned from this 2020 for the years to come. So the floor is yours, Dr. Nakhleh.
Thank you, Mark. Let me share quickly my screen with you because I have a few slides. And first of all, thank you very much for having me with you today. And again, among friends, and I call them the OPEC gurus, Herman and Yusuf. And I hope Herman, the OPEC Plus the meeting gets delayed so Herman doesn't escape the difficult questions. That wouldn't be a fair game. Now, there's a lot to cover here, and I think Herman did an excellent job addressing all the various dynamics that one should be aware of when looking at OPEC Plus. But I'm going to take a more macro perspective and put what's happening within OPEC Plus into the broader developments, not just of oil markets, but also of the economy, and of course, developments related to the pandemic. So what we saw, and that's why I have here an interesting title that we can, it's a little bit looking towards the longer term, whether we have here a transitory shock, whether it's just for the economy or the oil markets, or it's going to be a new path that we are overlooking in all these forecasts. And as an economist, I can assure you that all our forecasts tend to be, I wouldn't say wrong, but we don't get it right because of some changes in existing dynamics. And today, the risk is even higher because there could be some forces brewing and that are not being captured in current forecasts, whether for the global economy or for oil markets. So far what we had seen this year up until recently was that the pandemic has been driving the economy, and the economy has been driving what was happening on the oil demand front. And as a result, we saw the collapse in prices, and that triggered this massive reaction from OPEC Plus that Herman mentioned. That has been the case until, I would say, quite recently, but we are seeing this kind of connection or this one-directional linear relationship weakening, and I'll come back to that later on. But let's look first at how the pandemic hit the economy and how that translated into loss in oil demand, because that should make us think about what will happen next year, and not only next year, but in the coming few years. So Mark, in your introductory remarks, you said that this crisis takes us back to what happened perhaps in 2008, the financial crisis, and few other crises. But actually, this crisis, to quote the IMF, is like no other. You can see here, in terms of economic forecasts, the kind of gloomy economic growth for this year. Yes, and mind you, I don't want to bore you with the earlier forecast, but if you looked at the forecast, let's say from April and then until the summer and then until now, you can see that they have been worsening over time, not improving. And at the beginning, everybody expected a V-shaped recovery whereby we would go back to normality around the summer or end of this year, both for the global economy and for oil markets, and that has not happened. On the contrary, now we are still expecting perhaps a V-shaped recovery, but it keeps on being pushed further into the future. And it's not, in my opinion, what matters most is not whether we would simply recover, but when we would go back to the pre-COVID levels. And here are the big question marks, because if you look at international organizations and forecasting agencies, there seems to be a consensus that despite the development of the vaccine, and even if you're going to have 10 vaccines around as probably expected for next year, these have all been captured in the economic forecast scenario, and still we're not seeing the economy bouncing back to pre-COVID levels, not at least before a couple of years from now. That should make us think about the outlooks for oil markets as well. Now, to go back to my relationship that I said at the beginning, that you have COVID affected the economy, and as such, it has subsequently affected oil demand. Here you can see the massive drop in oil demand in spring this year. Originally, we're expecting this kind of continuous growth, which is showing here in the dotted blue line. Yet today, I mean, earlier this year, we had this massive decline. We are seeing a recovery, and of course, we have recovered, and that's why I put recovery actually between quotation marks, because we have to be careful when we use this term, because we are still not at the pre-COVID levels, and definitely not at where we expected to be, not even for next year, but maybe for at least 2022, if not further. Now, how did that, what was the main sector, I would say, that translated into this kind of loss in oil demand? It's definitely the transport sector, because in the transport sector, oil is king, so you hardly have any serious competitor. And with the lockdowns introduced, mobility stopped, air transport stopped, even, you know, road transport was affected. But definitely with air transport, we saw this massive dip in terms of commercial flight. And even though we have a recovery, some kind of recovery, people are traveling again, we are here. It's still well below where we started this year from, and also below the 2019 levels. And people are wondering when we would go back to the 2019 levels in terms of commercial flights. And here you have all sorts of diverging estimates, with some quite pessimistic views talking not before 2024. And one of the reasons being, although business traveling is perhaps a niche in the when we look at the total flights taken, but it's still with the way we have now adjusted to doing everything online, almost everything online, then there is a lot of this, you know, what we had pre-pandemic may not recover, even with the development of the vaccine, with digitalization and the reliance on communications means such as what we are doing now. Now, that was on the demand side. So we have a massive collapse in demand, and that, you know, that corresponded with a massive collapse in prices. And that led to the biggest, I would say, alliance. I have to be careful with the term alliance, because it's not quite in its legal definition, but let's use it now for the sake of this presentation. So the biggest alliance in the history of the oil industry. I'm not talking only about OPEC Plus that Herman referred to, and we are waiting eagerly for their decision today, but I'm talking about a bigger outside the OPEC Plus that, you know, we saw countries such as the US, which has for long been a big critique of OPEC and now of OPEC Plus, and then, you know, countries such as Canada, countries such as Brazil, agreeing to joining forces with OPEC Plus, and that's why people called it OPEC Plus Plus, to try to stop prices from collapsing further and support their recovery. But now today, of course, the big force remains OPEC Plus. But let me show you a little bit what happened on the oil price front, just to put some words into perspective, because I'm amazed how, and I'm sorry, Herman, I know you don't do it, but when people talk about a rally in oil prices, and you look at your screen, look at the numbers, and you see small changes here and there. But really, so this is what we had. We had the big collapse in prices in April. We did see a recovery in May. I would say rather quick recovery thanks to this OPEC Plus, and you can also add to it what is happening in the additional plus aspect. But I would say since June until now, have been in an amazing corridor, well-defined corridor of oil prices in the range of $40 to $45. And despite the rally that we saw, I shouldn't say rally, despite the increase that we saw in end of November, where Brent reached $45 or exceeded $48 a barrel, on the monthly average, we are still within that well-defined range of $40 to $45 a barrel. So really, and later we can leave that for the discussion, but when people ask me what will OPEC Plus do later today, I say it depends on what kind of price levels they would like to see. If they want to see prices breaking with this kind of range since June up until today, then the wiser thing or the more rational thing to do would be to delay their cuts by a few months up until, you know, perhaps the second quarter of 2021. But if they if they want them to go back to perhaps to the lower end range of this corridor, then they could relax their cuts. And why I'm saying that is because when you look at the market fundamentals, it's not just about, of course, it's demand, but there are other factors that we take into consideration to understand where the market is going, what kind of challenges faces an organization that is trying to put an upward pressure on prices. So first of all, there is the inventories, the commercial inventories, and for those of you who are not familiar, we put some, you know, so there is a certain quantity of oil that is put in storage, as we call inventories. There are, of course, outside the OECD, but we don't have publicly available data. That's how we use the OECD commercial stocks which is publicly available as an indicator of the conditions in the market. And here you can see the red line that we have accumulated, we have reached really record levels of oil stocks, because when you had low oil price environment, very weak demand and plentiful supplies, then you tend to put all this excess of supply, you accumulate in inventories. But when you have a drawdown in inventories, you have the demand is growing at a faster rate than supply, and therefore you start to draw down on the inventories built. But if you look at the last 5 years average, where we see here this range in gray, and the blue line, which were the levels that we had in 2019, you can see that although we started to get closer to the range, we are still outside, I would say, the range and well above the 2019 levels, which means that, okay, so far the OPEC Plus has been doing a great job in bringing those commercial stocks from their peak here down closer to the 5 years average, but that has been conditional to demand growing faster than supply. When you put back oil in the market, then you go to reverse, I would say, that kind of trend if the demand does not grow faster. The other element to keep in mind is the spare capacity. I hardly hear anyone talking today about OPEC crude spare capacity, but that is another important factor that tells me about the behavior of OPEC members and OPEC Plus in general, because historically, we have the following trend, that when you have a lot of spare capacity accumulated within OPEC, then you see more cheating among members, or in a more elegant way, less compliance. So members tend to be less compliant. But, and this is exactly what we're seeing, what we have today. We have really a very high level of spare capacity accumulated, and that for me explains the behavior of some members, in addition to their economic abilities to deliver on their promises. But we can discuss individual countries perhaps in the Q&A. And then here I add additional point, which is new supplies. Remember, we're talking here about a race. So imagine demand and supply, and we're going to see who's going to grow faster, because that will determine how quickly your inventories will be drawn down, and that will translate into either upward or downward pressure on prices. So we have the demand side, lots of uncertainties related to the demand side, especially for next year. And if you look at different forecasts, they keep on being revised. And the IEA, the International Energy Agency, OPEC, they're all quite conservative, I would say, in their forecast for next year, at least from what we saw in their outlooks for, let's say, the last month's November publications. But on the supply side, Herman mentioned Libya, and you can see here impressive reversal in fortunes in Libya within 2 months. Whether that will be sustainable or not, I really don't know. It all depends on politics, because Libya has a lot of capacity to increase its production. You can see they are producing even well below what they could produce, and I would say they have a much bigger capacity to do so. But because of the above ground difficulties, we are seeing this kind of constraint in production. But it has been, I would say, like on a roller coaster. And there are many question marks around the sustainability of the increase in production in Libya, but still that's a lot of oil coming to the market. And not only that, I know many people are quite pessimistic about the future of US shale oil, because mind you, one of the, I would say, the fundamental reason why we have OPEC Plus, why OPEC Plus came together in December 2016 was actually US shale production. And US shale production, unlike conventional oil, it responds quite fast to changes in oil price. And that's why I always said that shale oil is the first to leave the market and maybe the first to come back to the market because of this fast reaction to changes in prices. So yes, it wasn't surprising to see the massive drop in production, but you can see here, once oil prices kind of recovered from their bottom lows in spring and stabilized, we have also seen US oil production recovering and stabilizing around these levels. So I wouldn't rule out an increase in that production once prices increase. And I don't think we have heard the full story of US shale now. And mind you, from the beginning of the shale revolution, most people have underestimated shale. So it wasn't just about, predicting the demise of OPEC. Actually, there were many who predicted the end of shale right at the beginning. They described it as short-lived, overhyped, whatever. And then the industry in the US has proved everyone wrong. So that's something to keep an eye on. And then finally, my main message to you today is that when we look at all these forecasts, you see when you do economic forecast and all these models, they tend to be pretty deterministic and they follow a linear kind of thinking. But in economic theory, there's something we call a path-dependent process, whereby you can have, let's say, a shock, a big thing that hits your initial conditions, and that creates completely new conditions that create new paths, different paths from what we had before or what we were expecting. And the outcome is not just one linear outcome, but several outcomes that are quite difficult to assess, because you will have to analyze all sorts of conditions, including the changing conditions where we are today. So that's one thing to think about. So yes, we have the development of the vaccines. Maybe, OPEC Plus will reach a deal later today and things might look rosier for next week. But perhaps, so as I said in my recent publications on this subject, so it's like you're sailing in the dark and then suddenly you see lights on land. So of course it's good reasons to celebrate, because you feel that the end is within reach, but you're not there yet. So the seas can get rough. And actually I would say that you may end up reaching a place that you did not think of before. And this is where I think of poor Christopher Columbus, who ended up landing in the Americas instead of India when he was sailing. So that's something to keep in mind when you're looking at all these forecasts, and keep in mind that there could be completely new path emerging that current forecast and these deterministic models are not able to capture. Thank you.
Thank you so much, Dr. Nakhleh, for this holistic approach, if you'd like, and for setting the stage for a new path, let's say. So building on that, and here I'm gonna move to Yusuf. So building on what Dr. Nakhleh has mentioned, that it's gonna be a tough recovery, and we might not be going back to the initial scenario we were living at because of everything piling again when it comes to the economy, the pandemic, etc. So building on that, and also building on, we're going to benefit from your insider view, if like, of the OPEC dynamics and your experience in this. Where do you think the OPEC as an entity, and also the OPEC Plus allying, is going through? What are the expectations of the current meetings? And if you can also highlight on what you have been writing on and covering in terms of prices, are we going into a new path, into a new dynamic when it comes to oil prices, and will the players remain the same when it comes to managing and if you want this market, or handling this market of the oil price? So the floor is yours to give us your insights on that. You're muted. If you can unmute yourself, Yusuf.
Okay, thank you so much, Mark. And thanks for Herman and Dr. Carol for a wonderful presentation, very informative. And I agree, in fact, with most of the facts and theories that you have been presenting. In fact, I have been sharing with these views and a lot of the writings that I have done. By the way, I have a couple of slides. Can I show them? Okay, yeah, so because when it comes to prices, I just want to show where the prices have been and so it's very, very short, not so many slides, but just a couple of the slides that I would like to highlight on. So if you go to slide 2, please. Yeah. So responding to your question on where do you think prices might go? In fact, I agree with the presentation of Dr. Nakhla that we may not see even a smooth V-shaped recovery. And in fact, that's already happening. We are already seeing that. If we look into the past couple of years, since 2018, things have been quite stable. We've seen the prices at around $60 for Brent, between $60 and $70. And one of the most concerns that have been actually affecting the market were actually the U.S.-China trade tensions. So that has limited actually the growth in oil prices. The other things that would have also made an impact was the U.S.-Iran trade tensions. And of course, you all remember beginning of this year when the tensions between the United States and Iran was quite high, and that has led to prices of Brent reaching around $68 beginning of January, as I can see in this slide. Also, I remember here in Saudi Arabia when we had the Iranian drone attack on Saudi Aramco, which has really affected the markets. And of course, I would like to salute Saudi Aramco for the rapid response and bringing back supplies back into the market within a very quick speed. So this security of supply has been quite an important factor in 2019. Now, when we came to 2020, the COVID-19 has almost 2 billion people around the world went to total lockdown. And as you can see in this chart, since February, when prices start to decline, we have seen a kind of an agreement between Saudi Arabia and Russia. You all remember back in March, back in March the 4th of this year, when there was no agreement between Saudi Arabia and Russia, and that has led OPEC Plus to pump at its maximum capacity, which has led prices to for Brent touched about $15. In fact, WTI went into the negative scale due to the limited storage. We also have seen more than 1 billion barrels of including floating and onshore storage that were actually accumulated due to that excessive supplies. Then, of course, President Trump has played a key role in mediating an agreement between Saudi Arabia and Russia, which has led to the OPEC plus historic cuts, which actually were signed in April, implemented in May. As you can see, prices were almost double from less than $20 Brent. Now Brent is trading at around $48. So this is a great success under the current demand pictures. Yet demand continues to be much below its pre-crisis levels, as has been mentioned by my two colleagues, Dr. Carol and Herman. So but vaccines currently are bringing kind of a sustained optimism in the markets, although the demand continues to be below than its pre-crisis levels. And I don't think, in fact, that we can see 100 million barrels, which is equal to 2019 demand level in 2021. I think we need, as Dr. Carol said, we need a couple of years more. And that's not just because of universality of vaccine, or the access to the vaccine, but also due to the appetite to fuel consumptions. I don't think people will come back to do as much flying activity as we have seen before 2019. And I think it would take a bit of longer time. So consumer behavior, in other words, will play a major factor in that. We also are seeing a lot of universities and companies asking students and employees to work from home. So online activities is rising, increasing energy demand. For example, demand for gas and other sources of energy for stationary power generation is rising, while demand for fuel for mobile energy application is going down. And under these constraints, I think we could see a kind of possibly $50 if OPEC Plus manages to keep a good compliance in 2021, and vaccines take very good shape in terms of their access in next year. Yet the other issue, which is quite important here today, what I learned from today's meeting, that OPEC may actually be pumping 500,000 barrels, gradually increasing. So today, for the outcome of this meeting, as I heard, that they will agree on a 500,000 increase, and that will also increase by another 500,000 barrels in the next month, and another 500,000 barrels in March, bringing a total average cuts from 7.7 to about 6.7 million barrels. That certainly could have a kind of a slight negative impact on prices, because if they extend the agreement, certainly I would see prices going $50 or above, and that's something we have predicting back in June. If you go to the next slide, so this has been the slide forecast, and here I'm showing the points that started from back in 2019 until 2020. So we were predicting prices to reach exceed $50, yet we certainly, as Dr. Carol said, forecasts are always uncertain, and it's a very risky game. But at least we are seeing kind of the good thing in here is that we are seeing some good form of recovery, which could have not been expected beginning of 2020. If you move also to the next slide, please. So in the next year, so I think these are the 4 major issues that will play an important factor. So vaccines, as I have just mentioned, and public acceptance of vaccines, that will be an important factor. So how many people will be interested in accessing the vaccine? Of course, it will be a gradual thing. The more countries and more people try that vaccine, then the wider its acceptance will be. Of course, also the cost of accessing the vaccines, it shouldn't be only available to rich countries, it needs to be available on an equal basis. So I believe the G20 will play a crucial role in that, and Saudi Arabia has just hosted the G20 in November, and one of the most important issues that were discussed at this year's summit is pumping about $11 trillion into the economy as an economic stimulus from the G20, which will play an important factor in terms of supporting the world's moving out from the pandemic negative effects on the economy. So the other thing is, we'd like to see how President Biden will take the files from President Trump in terms of the relations with China. I don't think President Biden will be kind of will bring all the positive news to China. I think because his comments about China were not actually that supportive. But I think possibly he will have a slightly less tensions compared with President Trump, who has been possibly more aggressive towards his policy against China. The other thing that is emerging also in here is how Biden will handle Iran's nuclear deal. I don't think we're going to see an easy return to the Iranian nuclear deal. First, because the recent reports from the International Atomic Energy Agency are changing compared to the year in 2015. I would like also to highlight that I was also working for the International Atomic Energy Agency back in 2013 in Vienna. And when the reports come from the agency about Iran back there in 2013 were actually much better than we are seeing now. So possibly because in 2013, the IAEA has had a clean record with Iran, which has led the P5+1 to sign a nuclear deal, which has led Iran to repump its oil back into the markets. But currently, I think Iran needs to first solve its issues with the IAEA in terms of accessing all the nuclear sites. Of course, uranium enrichment levels, and all these issues that goes into the nuclear sector that must involve any new negotiation between Biden administration and Iran can be negotiated. Shale oil growth. I don't think shale oil will come back as 13 million barrels within the next couple of years, perhaps, and that's highly dependent on the prices. Currently, we're seeing a slight rebound in shale oil, and that's mainly because of the stability that I have just shown in the previous chart, where prices have been trading for more than a couple of months above $40, and that has been very supportive for the growth in the U.S. shale oil. Yet, I think also, as I heard from many U.S. Shale oil operators, that they are not very optimistic about bringing the supply back into 13 million barrels. So these are the final thing when it comes to Biden is the clean energy agenda. President Biden carries about $2 trillion investment in a clean energy agenda, and although I think this is a very good move because in terms of the environmental sustainability, yet not investing enough in the fuel or the oil industry could affect the supplies, and that could trigger prices to increase due to if the world recovers from COVID in the next couple of years, and there is not much enough investment in the industry, and already the industry is underinvested. The fourth and final factor that I would like to highlight is the cohesion within OPEC+. As Mr. Herman has mentioned very eloquently on how the dynamics among the group with changing interest, changing fiscal break-even prices, and the economies of different members within the organization, I think OPEC Plus needs to always try to find a common consensus in terms of achieving their national interests and leaving aside all the differences that could possibly bring back instability into the market, which we have already seen back in March in 2020. So these are the things because when we try to forecast prices or demand, these are the things that we are very much concerned about next year. So I would like now to give back the floor to Mark, and thank you so much.
Thank you again, Youssef, and thanks so much for those insightful remarks. I think you have set the stage to build up on what you have said and kick off the discussion. So a lot of uncertainties, a lot of constraints, and the recovery will be lengthy and it will be tough. And a lot of players and a lot of factors have to be taken into account when we look at those oil markets and those dynamics. So I see that Herman is still with us, so I'd like to benefit from his presence to kick off the discussion. So building, and also I have a lot of questions for you. I try to tackle as many as possible, and moving also to Dr. Nakhli. So kicking off from where Youssef ended when it comes to I know there's a lot of uncertainties. He mentioned many of them: the vaccine, the China deal, and also the OPEC Plus dynamics, and also the Biden. So from this point, regarding the Biden presidency, I have a question for you. That what would be a Biden presidency mean for the oil and gas? So Youssef has mentioned that he has a lot of promises when it comes to ban new oil and gas permits on public lands, on waters, etc. So are we, or should the oil and gas industry prepare the ground for far-reaching changes? Are we heading that way when it comes to the Biden presidency, or what are your insights on that?
Mark, sorry, because I have to disconnect and connect again. So this question is for me, right?
This is for Herman, and also we'd like to hear from you
okay, so please let Herman go first if he wants, and
yes.
I can add,
yes.
because I wasn't sure which one was it directed to.
No.
Yeah, sure. Well, I can answer the Biden question for sure. I mean, this is a administration that has a clear break from Trump's stance on climate issues. And we've seen the appointment of John Kerry as the special envoy for climate change. And this is going to be a huge priority. That said, President Biden is facing a Congress that is quite divided. Democrats, the party that Biden belongs to, don't have as much of a majority in the House, and the balance of the Senate remains very much in doubt pending two runoff races for the Senate in Georgia. So it's not entirely clear exactly what President Biden will be able to do unilaterally, and he'll certainly face a lot of opponents from producing states, Texas, New Mexico, North Dakota, Alaska, on some of these attempts. What he has said is that he may ban drilling on federal lands, and that's something that could take some time to implement. There are permits that have already been given that the holders of those permits have some years to drill. But if he follows through on that, I think our Platts Analytics arm is seeing about 1.5 million barrels per day of U.S. production that could be shut in as a result of that kind of action. That's something that the oil industry could be looking at. But I think just to bring a broader point to what both Dr. Naqvi and Dr. Shomari both talked about in terms of the health of the U.S. industry, it's going through a period right now of upheaval, as is the entire industry, but we're seeing a lot of consolidation among U.S. oil companies. And I think what's unique about the U.S. and to a certain extent Canada as well, these Western countries, it's not like a lot of these other Middle Eastern or other producers that have a national oil company where everything is centralized. The U.S. and Canada have a regime where it's a bunch of independent, privately owned companies all making their own independent decisions. This is why the U.S. will never formally become a member of OPEC, even though it might sort of cooperate obliquely on the side of OPEC Plus in terms of crisis situations. We're seeing a lot of consolidation in the U.S. market right now. Will it come out in a more solid position, health-wise? The U.S. shale companies are famous for burning through a lot of cash and not being profitable, even as they increase production. So maybe that'll bring some rationality, although we've been hearing about this for a number of years right now. So, and U.S. production just continues to go up. So I think that's something that for the oil market, and certainly OPEC is keeping an eye on.
Thank you, Herman. Dr. Naqvi, would you like to add on that?
Yeah, first of all, we have to be very careful when it comes to what politicians say, especially during presidential campaigns. And actually, if you look at the pledge of Biden, and here I have it actually in front of me, I took the opportunity to look for it while Herman was speaking, it refers to banning new oil and gas permitting on public lands and waters. Now, I don't understand what that means. Is he talking about new permitting for existing leases, or is it for new leases, or both, leases? So it's still very general and ambiguous, and we want to see more specifications related to this kind of definition. For me, it just remains too vague to assess its impact. But we did at Crystal Energy some assessment, taking an extreme case where the ban would affect existing and new leases. And we found that the impact is quite marginal, whether for oil or for gas, or actually both. So it does not have a significant impact in terms of production, nor of exports, whether LNG or oil exports. So I wouldn't put too much emphasis on that. There could be definitely tighter regulations that can make the life of producers more difficult. But I also want to remind the participants that the shale revolution happened under a Democrat president who promised to harness the wind and the sun, and not really under a Republican president.
Thank you, Dr. Naqvi. A follow-up question on that for you from Yasmina Abdelilah from the IEA, asking you, do you see that COVID-19 impacts on producing economies are affecting their plans for renewables with less revenues available? Do you think that a period of low oil prices will prove to be an opportunity for removal of subsidies in some countries? And if so, which ones?
Right. So here we have two questions. First of all, let me focus on the issue of renewable energy investment it was a Gulf producing countries, right? Now, what we have in the Middle East, and especially if you look at countries such as Saudi Arabia or the UAE, they have said they are, of course, very big oil and gas producers, or actually more oil than gas if you include Qatar, then you include gas as well. But so they have very ambitious targets for renewable energy or green energy, because would include nuclear as well into that. However, one thing which distinguishes these countries from other countries is the dependence of their economy on oil and gas revenues, on hydrocarbon revenues. And therefore, if you want to sponsor these kind of ambitious targets, especially that you have a bloated public sector, so the private sector in these economies is still limited compared to the presence of the public sector. And we all know that renewable energy requires government support, nuclear energy even more so, directly or indirectly. And therefore you wonder, so when you connect all these dots, you wonder whether what is going to happen today in investment in green energy, because this were going to be funded by hydrocarbons revenues, because this is the main source of revenue for the government in these countries. So therefore, if you have these revenues shrinking, then one would expect to see investment in green energy is going to be scaled down, and we are already seeing that. So when you look at some of the projects that have been cancelled, they fall under this green category. I would even include investment in hydrogen or some projects to reduce the impact on the environment. So this was quite predictable. As long as you have this kind of cycle whereby government revenues come largely from the hydrocarbon sector, and you have the private sector presence limited in these countries, then what happens to investment in renewable will be affected by what happens with government revenues. On the second question, it's subsidies. Exactly, subsidies. You know, typically we say that when you have a low oil price environment, especially if you're talking about subsidies that go for oil products consumption in these countries, that is a good opportunity, a golden opportunity for governments to reform their subsidies. And we saw that in the past. It's easier to remove subsidies when you have lower prices than when you have high prices. But I wouldn't single subsidies on their own. I would put them in the bigger picture of a wider economic reforms package. And this has always been the trend, whereby when you have a decline in oil prices, you find these governments announcing some serious economic reforms. However, many of these remain limited to announcements, and very few steps really materialize. Hopefully today it's going to be a bit different from the past, because, you know, we're sailing into the unknown, because in the past we nobody talked about peak oil demand. Today people are talking more and more about peak oil demand, and some even say that we already reached peak oil demand. So there is, I would say, a new sense of urgency for an old cliche to diversify the economy, to implement economic reforms, including reforming subsidies. But because again, you're talking to an economist who does not believe in subsidies, whatever sector they are targeting, because they lead to inefficient consumption. And they don't really support the poor. They actually tend to favor those with bigger houses and more cars to drive.
Thank you, Dr. Nakhli. I will come back to you regarding some additional questions when it comes to the major oil and gas companies and the super majors now and their investments in renewables. I have a lot of questions when it comes to the energy transition, and I know you've covered a lot on that during the past years. Yusuf, there's maybe two questions here that we can maybe answer live. First, from Hari Daher, asking you, can you comment on the drop between January and February 2019? That was before the COVID and the drop in demand. Was OPEC Plus not happy with continuing to abide by a ceiling in production? So that was maybe early before the pandemic. This is one. And another, like a consequent questions when it comes, how realistic do you think that the price war similar to the 2015 would come up, where prices collapse more than 40%? Are we seeing something in the near future similar to that?
So the first question was regarding the price drop in January 2019, right?
Yes, yes.
Yeah, I remember that time I was in Vienna. So Herman, you also remember that time? Okay, because I remember it was December 2018, we were in OPEC together. So at that time, it was still Minister Khalid Al-Falih, who was the Minister of Saudi Arabia. And I remember there was the US-China trade war that has been playing an important factor. President Trump has been a key opponent of OPEC policy when it came to high oil prices. You remember him in 2018, always tweeting against the increase in oil prices. Of course, due to the keeping gasoline prices in the US quite low for retail consumers. So that has been one factor. The other factor is the production from OPEC at that time compared to the demand level. I think these two important factors has contributed to the low prices that we've seen in beginning of 2019, mainly due to China economy influenced by the US-China trade war. The second question was regarding price wars.
Yes, price war.
I cannot predict how countries will react with each other yet. I'm sure that countries now are very happy with the current status of the market, and I'm sure that nobody wants these kind of tension over the market shares. And I hope they will always continue to be an agreement. Of course, sometimes the media kind of show an image that may not be necessarily the right image when it comes to negotiations between, like just a couple of days ago when Emirates was thought of they're going to exit the OPEC. Well, to my view, I just thought that that will not happen because I know that the GCC issues can be resolved very quickly, and I didn't see Emirates actually leaving the UAE, the OPEC organization. So under the current scenarios, in fact, I don't see any price war between the OPEC Plus members, even between Saudi Arabia and Russia, given the success that has happened. Also look into the duration of the agreement. Before, we used to see agreements lasting 6 months, 3 months. Now we're having an agreement lasting for 2 years. And that has given actually the market much more stability compared to previous agreements that started in 2016. One thing also, he asked me about price level in 2019. Look at prices since OPEC Plus alliance was formed. It was formed in 2016. At that time, prices of Brent was about $30, and then it went up. In fact, it reached in 2017, it was as high as $70, between $60 and $70. So I think the alliance was successful in fixing the market, and that the decline in prices back in 2016, as you remember, was due to the competition with the shale oil revolution, which happened in 2014 when OPEC decided to keep production before the formation of the OPEC Plus group.
And building on that, so all the reports and talks about the death of OPEC, let's say, have proved to be exaggerated, let's say. And this is in your opinion. Like today, it is a mandatory platform for those market recovery, if we're gonna call it.
I wouldn't say death of OPEC. Quite a big word. Well, as you can see, OPEC is not now working on its own. It's working with in terms of non-OPEC countries. So now we are seeing OPEC Plus, which is restoring kind of stability on the market. So it's not only OPEC alone now. In fact, if you listen to the speeches from Mr. Barkindo, more than 90 countries, oil producers were invited to join the group. So OPEC is looking to recruit more into the alliance rather than having people to exit the alliance. So I think even if OPEC on itself as an organization is possibly having less kind of an impact on the stability, yet it's working now with kind of a larger group that is restoring the market stability and bringing back its important role in the markets.
Thank you, Yusuf. Herman, like Yusuf has mentioned, the China's role when it comes to the market and back the deal with the US. China's economy has been hit by the pandemic, but they had some success in controlling, let's say, the COVID-19 consequences and to grow again with the economy this year. So there was a remarkable performance, and you have mentioned a bit of that in your presentation when it comes to the graphs, and a remarkable performance in time when it comes to China, while the world was suffering the downturn. What can you say on the Chinese role when it comes to the demand-supply game? Can you comment, like this is one of the questions on the Chinese market growth?
Sure. Yeah, I think right now, buying from China and India is largely what's keeping the market afloat. Obviously, conditions are much worse in the West in terms of the COVID pandemic, and so we've seen a strong economic growth, or I don't know if strong is the right word, but certainly a more robust economic growth in China and India, and that's really supporting the market. And this has led to a bit of a disconnect between what's happening in the West and what's happening in the East. And of course, Asia is the big demand center for oil, and so it's a huge customer of OPEC and OPEC Plus members. I had that graphic that showed the intra-OPEC competition between Russia and Saudi, and certainly Asia is one of the big battlegrounds that they are battling over. So that's one of the things that's sort of giving OPEC a little bit of a pause in terms of what to do about these production cuts going forward. Certainly, we're seeing China do better than what it is. But I think overall in the oil market, I think it's the graph that Carol showed early on about what the level of demand was. We saw the demand destruction happen in the spring. We've seen, I don't know if you want us to call it the rally or a rebound, but we're still not at where we were before. And, even, I want to say that even entering 2020, a year ago at this time, we were sitting here and looking at all the forecasts of 2020 before the pandemic had really even entered our consciousness yet. And 2020 was already shaping out to be a tough year. There's a lot of talk about global demand growth being anemic. Maybe less than 1%, typically less than 1% oil demand growth. We talk about the world potentially entering a recession. And so a lot of speculation about whether the world would enter a recession. And then, of course, COVID-19 hit. And, a recession was the least of our worries, or a mild recession that we were talking about back in December of 2019, looking into 2020. That was the least of our worries. And so even if we do have these these vaccines, and we do get back to quote unquote normal, it's still not a very healthy market, or certainly not a robust market with robust growth that we're looking at. And so I think that's why you're seeing some of these OPEC countries becoming a little nervous, a little bit antsy. And I think the key question for OPEC, not so much what to do these next 3 months ahead, is what to do for the back half of the year. And that's really the hard questions that OPEC Plus is looking at. Maybe that's entering some of the hard discussions today. But I think there's, once you decide on what to do for the next 3 months, it's really the critical, what do you do through the spring and the summer? That's really going to be critical for how OPEC Plus sets up the year.
Thanks, Herman. Moving again to Dr. Nakhli, and as I mentioned, you have a question from Mrs. Etni Trinor from Dubai. She's saying that the majority of IOCs have declared their intentions moving towards net zero emissions, and some other NOCs have followed. Do you think that we need to see all oil companies on board in order to secure future investments and survival?
Yeah, I'm not quite sure what it means on board, like in terms of everyone has to reach net zero to survive as an industry, or to survive as in terms of climate. But anyway, let me try to repackage. Now, of course, you see, climate change is a global problem, and it's affecting everyone. So it's not something that people can select to say, oh, let X deal with it, and I will deal with something else. And when you are in the oil and gas business, you're seen as a bad guy. And especially today with all this craze about ESGs and green investment and moral money, you name it. So I can understand the concern of these companies, and also add to that the more, I would say, tangible risk that is peak oil demand. So all in all, if you were in the oil business and you're planning investment for the next 30, 40 years, because if you're talking about conventional oil, this is at least the duration of an oil project, then you ought to be concerned. So you want to do something that can kind of protect you to a certain extent, allow you to stay in the business for as long as possible. And this is where these companies are coming from. And you can see that it started actually with, I would say, the European companies are more aggressive than the North American ones, especially if we're talking about the oil majors. Now, that is, in my opinion, perhaps the apparent story. But one of the things I like about studying oil markets, and you mentioned earlier that I teach in one of the courses, one of the sessions I teach, is the evolution of the oil and gas industry from the 1800s up until today. And it's not the first time that companies, big oil companies, try to venture into another area of business to diversify their operations and reduce their exposure to external factors. Let me here select one example from perhaps the 1980s, where you had companies like BP investing in nutrition, ExxonMobil even investing in producing office equipment such as typewriters, and they even ventured in mining. And I would say mining would share perhaps more similarities with oil and gas than green energy or renewable energy. And yet 10 years later, these companies discovered that none of these ventures was worthwhile, and they divested from it. And today you wonder whether this kind of diversification, whether it will be good for these companies or not. Nobody really knows. I think only time will tell us. But to put into perspective, let's go beyond the big headlines and talk about these net zero targets. Also think about the percentage of capital spending that these companies have put in greener projects. And here I want to quote a study by the IEA, which was published earlier this year. And they looked at IOCs, international oil companies and national oil companies. And they took a group of the largest ones, and they found that where things stand, there is less than 1% of these companies spending that goes into green projects. So whatever they are announcing, they are starting from a very, very low base, and they're putting still a lot of weight on their conventional business. Now, there is another dimension to that, which is bigger, if you allow me, and this is perhaps for me is of more of interest, and that could be an opportunity for national oil companies, especially those that come from the OPEC countries, because if you have the IOCs, and which are headquartered in the OECD, in the rich economies, which are most aggressive on climate change policies. So if they have these companies investing less and less or producing less and less oil, even though we have energy transition, we still need oil to meet our energy needs for several decades to come. So you're leaving here more space for the national oil companies, a bigger gap to fill. And that could be an opportunity for these players to fill the gap left by the international oil companies. So the kind of competition that we have today will take a different shape, will take a different structure, and where we're not going to reduce our dependence on the Middle East or on OPEC. Actually, we're going to increase it if the trend continues.
Thank you, Dr. Nakhli. And really, I have a few more minutes left, but I have a lot of questions. So I thank you again for being so generous with us when it comes to NIME. I'll try to address a couple of them maybe quickly, and please feel free in the Q&A box. We have a lot of questions coming in. So if you'd like to type the answers, I see some of them are for Herman and some others related to, but I would to price. But I would like to, there's a question to Yusuf from Prince Fahd University in KSA, from Nasser Murehel. He's asking, like you have said that the oil price it's not sure, and it's really difficult to have $100 price or a barrel again and to see the things same as before. So can we really based on what Dr. Nakhli have shown at the end of her presentation, and can really expect or project the oil price until the next decade, like the 2030, or it is really impossible to do that with all the constraints we have mentioned and all the difficulties you have mentioned as well? You're muted.
Okay, well, I would like to give part of the response, and I would like Dr. Carol also to give part of this, because she's also an economist. When at CME Markets, we only look into the short-term prices. We don't look into the long-term prices like the IEA will do, or the EIA, the US administration. And that's because we are mainly dealing with traders. Governments, possibly they like to look into more than 5 years because they want to plan their budget. Yet I think it's nearly impossible to predict 100% how much the oil prices will look like within 10 years from now. Yet I can give a rough idea based on how much I think demand will look like from now until 2030. If demand continues to go down and not to grow as, for example, according to OPEC forecast, it's expected to reach about 110 million barrels by 2040. So if we say, for example, 105 barrels by 2030, so how much supplies do we have in there? And I think based on these factors, we can predict. Yet, I don't think we're going to see $100 a barrel within the next, for example, 5 years. I think we're going to stay, if we recover from the pandemic, we could go back to prices around $60 for Brent. But of course, that depends, of course, on how many suppliers will be out there in the markets. Of course, it also depends on the growth in non-OPEC producers. So the US, Canada, Russia, and always when you have high prices, more producers will come into the picture. So that's why I don't think prices will jump too much.
Thank you, Youssef. Dr. Nakhleh, you would like to add something on that before?
Yeah, I mean, if I had my, one slide in front of me, I would have showed you how when you look at long-term oil price forecasts from the IMF or the US Energy Information Administration, it's very interesting because I have two graphs showing how the actual oil price and all the attempts to forecast prices, especially for the longer term, and they never got it right. And I always compare forecasting the oil prices, especially for the long term, is like trying to predict the weather. And mind, conditions change, and people sometimes they overlook those fundamental changes. Let's not look too far. Look at the beginning of this year, before the pandemic hit, when there were the tensions, the rising tensions, geopolitical tensions between the US and Iran. Even then, some people predicted a jump in oil prices, only for oil prices to dive in the opposite direction. Because it's like the shale revolution. Nobody foresaw the shale revolution happening, and that had changed a lot the dynamics of prices and their reaction to developments, for example, in geopolitics. So I wouldn't like to say predicting the oil price in the long term. That is really like mission impossible. And I have many examples that shows how even the brightest mind got it wrong. But we can provide different ranges of scenarios, I would say, and not forecasts. That would be more accurate description.
Thank you, Dr. Nakhleh. And there's a lot of questions, but we are very short on time, and I know you are a lot. So we were very lucky to have Herman with us as well, like for the meeting, not to start perhaps maybe, and to have him throughout all the webinar. There's a couple more questions, but I'll try to send them maybe later on via email, or you can feel free to answer them in the chat box from Mark, Zaid Wahab, and Konstantinos. I would like to thank everyone who has stayed with us until this time and to listen to this webinar. And to our esteemed panelists, Dr. Nakhleh, Herman, and Youssef, thank you again for your time, for your insights, and for everything you have presented. I know this is an unusual time and a year we are living, and everything seems too unpredictable. And nevertheless, I hope we have tried to present a short-term outlook for everyone looking to know what would the dynamics in the OPEC and OPEC Plus would mean, and what are the oil outlook expectations for the coming a couple of years. With this being said, I would like to thank you for your presence and participation, and thank everyone who who asked questions and also raised some concerns and questions earlier than the webinar. I hope that maybe after this, the new maybe forecast in 3 months' time, in March or April, we will have a clearer view of the outlook for the coming decade. So thank you so much again, and I look forward to future webinars on this platform.
Thank you. Bye-bye.
Thank you, Herman. Thank you, Yusuf.
Thank you all. Thank you. Have a nice day.